Hi there, I'm Mark Sebastian, the founder of OptionPit.com, and this is Trading the VIX and VIX ETPs. I'd like to remind everybody this is for educational purposes only. None of this should be considered investment advice. Options have risk. This is not any kind of advice. So basically, if you do something and you lose money, it's your fault. That's what we mean. So this is me. My name, I'm not the redhead on the right. I don't work for Fox Business. But I was a trader on the floor for about 10 years. And after I left the floor, I started OptionPit. OptionPit is a education and consulting company. We specialize in working with retail traders and institutional guys, generally smaller, teaching them how to trade like a professional. And then with some of the institutional guys, I actually had a guy in this week, runs a big RIA. And I worked with him, showing him how we work together, looking at redacted client portfolios, building out hedges, which was kind of fun. In addition to that, I run 2 hedge funds. I'm the head trader for 2 hedge funds: a Vol fund and a smart S&P fund. I also just published my second book. It's called Trading Options for Edge. Read it. If you only read one options book and you know options better than your average person, read my book. It's really, really good. And it was not ghostwritten. This is one that I wrote myself. So you'll be happy if you read it. All right. Here's what you're going to learn. We're going to talk about what is volatility, what is the VIX, ways to trade VIX, ways to trade VIX ETPs, and strategies for trading them. So we will spend a decent amount of time kind of digging into this. And so I like to build things on a crescendo. So it's going to start out a little easy, but it'll get harder and harder. Please refrain from asking questions until I ask, unless it's super pressing. All right, so what is volatility? Volatility is a measure of movement of an underlying instrument over a period of time, regardless of direction. So it's movement over a time series is what it comes down to. The higher the volatility, the higher the movement and or expected movement of the underlying. When we discuss volatility, no matter how long to expiration, no matter how long the period, volatility is an annualized number. So if you're looking at a 6-month set, the volatility that you come up with will still be an annual number. All right, in our thing. So that means that, if we come up with a volatility for a 6-month time period, that number would be for an annual, how much it would move annually at that rate. So different types of vols. There are 3 different types of vols. All right. 2 that are kind of the same, and then 1 that is very different. So the first one is historical vol. That is how much the underlying has moved in the past. So how much has the data set moved around in the past? All right. You can look over 30 days, 60 days, 100 days, you name it. Then the second one is realized volatility. Now, what is realized volatility? Realized every movement, as soon as movement has happened, it's in the past. Right? If I take a step forward, my step took place in the past. Even if you walk backwards, your backwards walk was in the past. Yes, walking backwards and forwards is just creating up and down movement in the past. So, but when I talk about realized volatility, I'm talking about extremely short-dated movement. So call it fewer than 10 days. All right. Then finally, we have implied volatility. Now, what is implied volatility? Implied volatility is how much we think something is going to move. In the case of options, it's what the market is expecting an underlying to move based on option pricing. All right. So what makes stock trading different than volatility trading? Well, over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. There is a mean reverting characteristic to a volatility. So here is a chart of Apple through the end of October. And what do you notice? I mean, there are people that will say, oh, you know, it has this little chart pattern here for this period and that period and this period and that period. All right. There are definitely near-term mean reversion. I'll give you that. All right. But over the long haul, that light gray, that gray-blue line is the 200-day moving average. Does that look like it has any mean reverting characteristics? The answer is no, it does not. Now here is the VIX of Apple. So this is implied volatility of Apple options with using the VIX methodology, which I'll discuss shortly. So basically this is the implied volatility of Apple. Now you look at that 200-day moving average. Does that look like that has mean reverting characteristics? Yeah. I mean, that 200-day is about as flat as a pancake. It really is. So basically, again, a stock can go anywhere and stay there. That's the key. It can stay there. So Apple goes to 175. There's no rule that states that it has to go back to 100. Yeah, I know. All right. So there is volatility can go anywhere, but it can't stay there. So if you think about the crash of 87, all right, the VIX would have been over 100. It's now 9. All right. The VIX of 9 will not stay there forever. It will not. It may seem that way, but it will not. All right. So stock price can just stay high. The S&P is 2767. There's no rule stating that it has to go back to 2400. All right. And understanding that will help you with buy and sell decisions. All right. So the one confusing thing I think for most traders is they think that mean reversion is a quick thing. I can tell you, I've seen periods of volatility where it stays very low for very long. We're in the middle of one of those. All right. We've seen low periods of volatility. I've seen it if the VIX existed in 1970, there are people that think it would have maybe never broken 10. It would have been really inexpensive. But it can also go sky high. In August 2015, VIX got to 53, and it stayed elevated, basically above 20 for about 6 months straight. You know how to get, the long-term mean of VIX is around 17. How many 20 prints do you need against a bunch of 9 prints to get an average of 17? Right, so vol doesn't stay high as long as it stays low, but it can go a lot higher than it can go lower. There's a lower bound. So the thing to remember is that not to have a recency bias. What's happened recently is the way things always are. And there are a lot of people that get into that habit. It's a mistake. Don't have a recency bias. What's happened in the last 6 months is not the long term. Now, that doesn't mean now, when I say don't have a recency bias, I don't mean don't trade what's in front of you and don't assume that vol's going to stay for the next low for the next week. But what I'm saying is that be open to the fact that things can change. If you're not open to the fact that I can remember the most hilarious thing ever at the CBOE Risk Management Conference. All right, it's the best conference on vol every year. Who's the Dr. Doom guy from that was like an economist? You know, Dr. Doom, the world's ending. Oh, he did not. It wasn't Dent. I don't think he died. Anyway, there was this guy, Richard Dent, not Mark Faber. There's another guy. Yeah, Nouriel Roubini. That's who it is. Thank you. Nouriel Roubini. He literally gave a speech in March of 2009 exclaiming that 40 was the new 20 for VIX, that volatility was going to stay high forever. It was like March 6, 2009. Why? Well, guess what? Volatility had been high for almost a year. You know, people think that 2008 came in a bubble. I was trading on the floor in 2008. By the summer of 2008, so by June, the VIX was already in the 30s. So that's the thing to remember. So don't have a bias that everything has to stay the same. Volatility can go really high and stay there. It can also go super low. All right. So that's why I'm saying it's important not to have a recency bias. Cool? Cool. All right, so now let's talk about the VIX. The VIX is the SIBO Volatility Index. Excuse me. It's no longer SIBO. It's no longer SIBO. It's SIBO. That's right. Now it's not all caps. It's SIBO Global Markets, not the Chicago Board Options Exchange. So they paid some marketing firm a lot of money to lowercase 3 letters. So the SIBO Volatility Index, the purpose of the index is to gauge the buying and selling of options. I had somebody say, hey, I thought the VIX is the gauge on buying puts. No, it is the gauge on buying and selling of all options in the SPX that have and we'll talk about the duration, 30 days. It gauges what I call the cost of insurance. And calls are insurance, so are puts. So the idea is that when there's more buying over selling, generally the market is trying to buy protection. When there's more selling than buying, the market is not out seeking protection. So basically, VIX up, cost of insurance is up, and vice versa. So similar to the S&P, the index is not actually traded. A lot of people don't realize this, but you can't go out and buy the S&P 500. All right. All right. So you can't buy VIX. You can't buy S&P. You can buy S&P futures. You can buy SPY. You can buy a basket. All right. There's all sorts of things you can buy, but it is not the S&P itself, the index itself. There are things that mimic it that correlate 99.99%, but nothing is perfect with the S&P. VIX is even worse. You know, if with S&P I can create a basket, those are not VIX. Someone wrote VXX, UVXY, TVIX. None of those are actually VIX. They don't recreate VIX. Right? SPY 99.99 recreates S&P. There is nothing that really comes close to correlating most of the time to about 60% of VIX. 0.6. Is the put-call ratio related to the VIX? No. No, it is not. The put-call ratio measures the ratio of calls bought to puts being bought. VIX measures kind of overall buying of everything and how much it costs to buy that stuff. They don't care whether they're calls or puts. So what the VIX is essentially an estimate of implied volatility on the S&P options that has a constant duration of 30 days. All right. Constant duration means that it tends to constantly, sometimes comically, but constantly mimic a portfolio with 30 days to expire. So today, the VIX had 30 days to expire. Tomorrow, the VIX will have 30 days to expire. Tuesday, the VIX will have 30 days to expire. All right, every day that you look at the VIX, it always has 30 days to expire. That's what constant duration means. The VIX is quoted as a price, but it is really a percentage. Volatility, despite not being spoken as a percent, is always a percent. Always. So when the VIX is 10, it's actually 10% annualized volatility. That's what it's measuring. All right, 10% annualized expected movement over the next 30 days. So that means for the next month, we're expecting the S&P to move at 10% annualized. Think about it this way. If I run as fast as I can for a minute, right? No. So if I run as fast as I can for a minute, they can convert that into miles per hour, right? He ran this far in 1 minute. How many miles per hour is that? That's kind of what VIX is. Make sense? Make sense? Yeah, it makes sense. Pretty easy. Easy stuff. So, here's what the VIX has done over the last 3 years, and this is a weekly chart, so these are weekly points. And what I want to point out is that in the last 3 years, the weekly average has been over 40. There was a period of time where that weekly average basically stayed above 20. It also dropped 25% in 1 week. Yes, VIX can drop quickly. Does that mean it was accounted, the activity in the past 12 months for that 10%? No. What that means is that looking ahead, it thinks on an annualized basis the S&P is going to move 10%. All right, so if you wanted to calculate that, you would do 0.1 divided by the square root of 30 over 365. And that's the movement that we're really looking at. So, the VIX negatively correlates with the S&P 500. When the SPX is up, VIX is generally down. When SPX is down, VIX is generally up. My golden doodle doesn't like that. You asked me that at the end, Steve. So, This makes sense as generally when the market sells off, volatility does increase. Nope, that's the doodle. There is also the nature of similar movement against a lower number. All right. In addition, there are some features of the VIX calc that can cause it to increase in a sell-off. I don't want to get too deep into the VIX calculation, but just understand that when the SPX is up, 80% of the time, 85% of the time, the VIX is down. And when the SPX is down, 90% of the time, VIX is up. So now, any questions on VIX? All right. So, any questions on VIX? Great. If VIX is 10% annualized for 30 days, does that mean a 2% variance for the month? I mean, you would basically, go back the other way. You'd square it. Yeah. I don't know. What's 0.1 squared? Yes, Farida, you did. I'll explain how VXX work. And yes, a recording will be sent. All right. So, someone wrote, I bought VXX at election time and lost money. I'll explain why. All right, so now, let's talk about the VIX Futures. The VIX Futures are the most successful product that has been released domestically in the last 20 years. Not a listed future. There's not a single listed future that does as well as VIX. All right. They trade out 8 months plus the weekly VIX futures, which don't trade very much. Each month trades independently, not like the structure of SPX. So if I trade so right now the active month in the S&P 500, all right. So if I trade the active in S&P, which is March, how closely will June correlate to March? June is the next quarter. The next major is the next future. How well do they correlate? They correlate at almost 100. All right. Save the theoreticals and the ETP questions until I'm done. All right, and then I'll answer every single question you guys have. All right. No, in SPX, in the S&P 500, the March future and the June future correlate at like 99%. The only difference is cost of carry. Meanwhile, the VIX futures do not correlate like that. If you go the front month future at about 30 days to expire is going to move very differently than the 60-day future, is going to move very differently than the 90-day future. They move more like a chain. Think of S&P movement is more like if I hold a broomstick in my hand and I move it up and down. That's kind of how S&P is going to move. Now think more of VIX as holding the end of a jump rope and flipping my arm up and down. The other end of the jump rope is going to be near-term VIX. the stuff near my arm is going to be long dated VIX. The stuff away from my arm is going to move a lot more and a lot more wild. Does that make sense? Right. Good. All right. So that's really how the VIX futures work. All right. So VIX futures are in a contango north of 80% of the time. That means near-term contracts are less expensive than long-term contracts. And they're almost always used as a hedge. There are a lot of people that day trade them, but the big players use them as a hedge. This is what the VIX futures looked like a couple months ago. So what you are looking at, I don't understand contango and backwardation. What you are looking at is contango. So that blue dot over here, this blue dot is the November future. It's trading 1137 at the time. All right. The December is 1230. The VIX cash is 985. So the fact that the cash is cheaper than the Nov future, is cheaper than December, is cheaper than January, that is contango. This is backwardation. The front month future is more expensive than the next month, is more expensive than the next month. All right, now, here is the one, if you only take one lesson away from here, all right, how many of you have these great systems that you follow? You know, I do, when this happens, I do this, when this happens, I do this, and at this period of time, I do this, and at this period of time, I do this. You know, at 30 days to expiration, I put in this type of butterfly, then I put on this butterfly, then I do a condor at 60 days to expiration, blah, blah, blah. I've got this whole written plan, right? I do, you know, this is, anybody trade a mechanical system? Yeah, mechanical. Anybody have a system where they've named a condor or a butterfly? You know, I've got the Spazdor condor. I've got the floppy soggy arm butterfly. I've got the Sesame Street calendar. I've got the Cookie Monster credit spread. All right, so two lessons I'm going to give you guys. One, if somebody named a trade, that doesn't mean it works. That means they want to sell it. So if somebody comes in, I call this trade the Rolaids butterfly system. All right. Guess what? It's designed to sell you something, not to work. All right. I run a couple of hedge funds. I talk to my traders about what I think, how I think. I talk to my traders about the type of stuff I like. But who here thinks I tell my traders exactly what I'm doing? The We Got It Made calendar spread, right? No one. And I've got a couple students here, and they'll tell you I do not do that. You know, maybe an hour later I'll say, hey, I did this an hour ago. I mean, our goal is to teach you how I think, not what I do. You are, you know, I'm a teach a man to fish person, if you will. So here's the big takeaway that I want you to go by, though. If you have a mechanical system or a system that has a trade name, a named trade, when you see this structure here called backwardation, when you see backwardation, this, all of your rules are going to go out the window. They're not going to work. Anybody who's traded before 2008 or before 2011 can tell you that your system stopped working when the market goes insane. So if you take nothing from here other than this, you'll be better off. When you see the market going, the VIX futures go into backwardation, abandon your mechanical approaches. Unless you have this type of approach built into it. This means that logic is gone. This means the market is terrified. You ever tried to apply logic to a 7-year-old having a temper tantrum? You can find it at VIXCentral.com. My friend Eli. Anybody ever tried to apply logic to a 7-year-old with a temper tantrum? Does it work? No. So what ends up happening? Eventually, you hug the kid, you put them in somewhere where they're in a position to calm down, and then once they're calm, what do? You have a logical conversation with them. All right? This formation is a temper tantrum. This is your child. This is your child or somebody else's child once they've calmed down. That makes sense? Any questions on contango or backwardation? Great. Needless to say, my son turns 8 tomorrow, so I maybe was applying some real life to this. He did not have a temper tantrum tonight, though. He's a good kid. Most of the time. Except for when he's having a temper tantrum. All right, so let's talk about VIX options. They are the most successful option product traded in the last 20 years. They trade out 8 months plus the 4 weekly options. Now, the weekly options have a ton of volume. The futures do not, but the weekly options trade size. Again, each month trades independently, and this is important. The underlying for a VIX option is the VIX future, not the VIX cash index. So, if I'm buying a February call option, what is the underlying for my February call option? This should be simple, as I just said it. The Feb future, correct. Thank you. And again, a lot of people like to trade these in all sorts of ways. But all of the big paper is hedging. It's almost all hedges. Characteristics. VIX options and futures. I will talk about that, Dan. VIX options and futures are European exercise. This means there's no early exercise. They have a unique settlement procedure. All right. And it's the same as the VIX futures. And rule number 2, don't mess with VIX settlement. All right. VIX settlement can be such a crapshoot, it's not worth it. All right. At 30 days to expiration, that's VXX. At 30 days to expiration, typically, the VIX future will move at a beta of about 0.5 to 0.6 of the VIX. As time passes, that beta increases. So the January VIX future expires next Wednesday. Right now, January VIX futures correlate to the VIX cash index at about 80%, 0.8. So that beta is increasing. Next Tuesday, the day before expiration, they will correlate at about 95%, 0.95 beta. All right, now I want you to notice how much volume there is. This is from a while back, but take a look. This was a slow day, and VIX Options had already done 600,000 contracts. All right, I used to trade Best Buy super actively. Best Buy has less open interest than VIX did in volume this day by about 25.2 on a factor of 0.25. All right, open interest about 12 million contracts. That's a ton of volume. They aren't messing around. So, all right, using VIX options. This is important. Recall, the VIX options, the at-the-money strike is not the cash VIX, but it is the futures VIX. So every month has its own at-the-money option. So at this time, the at-the-money for the November options was 11.5. For December, call it 12.5. No, January, 13.5. So the at-the-money option is not the same for every month, and it's a moving target. This is what makes people not like VIX, and this is why I love VIX. Where do you think the street makes more money? In stuff that's a little harder to trade, or the stuff that's easy to trade? The harder it is to understand, the more money there is to be made in it. It's the truth. All right, so let's talk about trading short. Most retail traders who make up a small slice of VIX trade it short. But now, not always, but most. Best way to trade VIX is a short. Long puts or put spreads, and I'll show you what I mean. Trading short. So a long put simulates a short future only with capped losses. It has a little time premium, but not a lot. And the premium is less for out-of-the-money spreads. So a useful trade is the convergence trade. So what you're betting is the future will grind lower toward the VIX cash. What you're meaning is betting is that the VIX is 985 in November. What you're betting is that it will settle around 985. And if you trade a put option where the at the money is 11.5, something will happen. So let me show you. This is a convergence trade. I sell a September future at 1442, assuming the VIX is going to get to 1140. Or I buy a put, assuming the VIX is going to get to 1140. All I'm really betting is that things are going to stay the same. Does the market tend to have an inertia to it in the near term? Yes. So let's take a look. Jan options with a VIX 985. Should I be able to buy a Jan 12 put for $1? What do you think? Should I be able to buy the Jan 12 put for $1? Let's do some math. What is 12 minus 1? All right. 11. All right. What is 11 minus 985? 115. So should I have a $1.15 difference between where the underlying is and how much I'm buying my put for? Does that make a lot of sense to you? No. All right, so let me show you something. I thought I had live all open. Sorry, folks. Here's VIX. VIX settled 988, so it's actually up 3 cents. How much do you guys think the 12 puts cost? Without looking, how much do you think the 12 puts cost? Well, the answer is about 170. So the VIX went up 3 cents from here, and yet my puts that I bought for $1 are up 70 cents. I did nothing. I bought a put and I sat, and I made 70 cents. The VIX did nothing. Stayed where it is. Have you ever heard of a put where you can buy a put option, the underlying stays the same, and you make money? You see how VIX can be a little confusing, right? Well, it's because the future has to converge to the cash eventually. So that slow process of the future converging to the cash creates that edge. Kind of neat, right? All right, now let's talk about trading long. There are good reasons to trade long. You know, if I had a big S&P 500 portfolio, I would be hedging it right now. Vol is cheap. It's a bit like time decay. It really is. What's interesting is a VIX future has a theta, a time decay. So, trading long, I have no problem trading long. All right, but you have to do it the smart way. So when I want to trade long, so let's say I've got a $2 million portfolio of S&P. With the VIX at 985, I'm sorry, but with the VIX at 985 and the S&P just on a tear, if you're not hedging off some of your S&P risk in VIX, you are borderline irresponsible. So what I would do is use the VIX to my advantage. So the way to do it, because of skew, is to buy a call that is at the money and sell an out of the money call, and you can do pretty well. So because of VIX vertical skew, call spreads are great. Let me show you. Take a look at this, and don't ignore the 1/20 thing. There is another trade down here that also has 20. These are unrelated positions. So what I want you to notice is how much does the 12.5 20 call spread cost? $0.95. All right. We've seen how the VIX can spike, right? It can go from 9 to 15 back to 9, but when it goes 15, it really goes 15. I can make a lot of money hedging by buying that call spread. It's got a great payout. That risk reward is amazing. I got a 7.5 point vertical for 95 cents. Remember, at the time, VIX was about 10. 2.5 point move's not a big deal. That's 35 points in the S&P. That's Mr. Ross saying that, implying some sort of weird collusion thing. And VIX going from 9 to 17. All right, so any questions on VIX and how you might set up hedges and how you might trade convergence? That's a great question. So the question was, if you have a long stock portfolio, 50,000 shares of S&P, how would you equate that to VIX? How many call spreads? How would you hedge it in another way? I would absolutely hedge it in VIX. And frankly, that would require a couple of individual sessions where I sit down and work with that person, because that is a lot of money in SPY, and that needs some true understanding. So I don't want to get into it on an individual basis, but I would say that VIX would be an excellent hedge against that. Well, and I'll explain why VIX is a better hedge than S&P. All right. So 2 months ago, where was the S&P? I can tell you, right? So when I was looking at this trade, VIX was 985, right? Where is the S&P in early November? I'll show you. Flip SPY. In early November, SPY was 256. It's now it's up $20. VIX hasn't moved. So VIX has this sticky strike value. The S&P can't run away from a VIX hedge like it can an S&P hedge. All right, so let's talk about the volatility ETNs. So VXX, UVXY, SVXY. They have a stated purpose, but due to the structure of the futures, they have some unintended consequences. So let's talk about that. Who's ever heard of King Sisyphus? If you haven't, please read this. Some pretty good Greek mythology, isn't it? Yeah, so Zeus displayed his own cleverness by enchanting a boulder to roll away from King Sisyphus before it reached the top, which ended up consigning Sisyphus to an eternity of useless and unending frustration. That is VXX. VXX is the iPath short-term S&P 500 future, ETN. It attempts to replicate being long a VIX future with a concentration of 30 days. Concentration makes sense, right? VIX has a concentration of 30 days. Why wouldn't you want a future with a concentration of 30 days? The intent of the fund is to allow traders to get a short-term view of near-dated volatility, a near-term view of a 30-day VIX future. The fund does this by rolling out of the front month and into the second month. So this is going to be overly simplified, but think about it this way. How would you run a business where you buy something for $16.10 and sell it at $15.50? How do you think that would go for you? Well, I don't know. This is Tesla, and their market cap keeps going up. Yeah, you blow out. You would go out of business. So now, this is not exactly right, but if one share of VIX of VXX, if you bought one share of VXX on the day it listed, or excuse me, VXX right now is $25.84. Split adjusted, how much did this share cost on the day it was listed? Split adjusted, how much did a share of VXX cost on the day it listed? What do you think? Take a guess, everybody. $250, $100,000. What else? Keep them coming. No cheating. Farida, you cheated. Admit it. So did you, Corey. Cheater, cheater, pumpkin eater. $102,512. So the whole point is VXX is rolling itself to zero. It shouldn't be held for more than a few hours if futures are Contango. It's a great day trading product. It really is. If I've got a long volatility portfolio, let's say I'm a big straddle buyer or a long call buyer, or I love buying options. I own calendars. Anybody here a calendar trader? VXX is a great hedge against falling volatility. It's a terrible hedge for more than a day against rising volatility unless futures are in a backwardation. Then it's fine. I mean, this is just since, I mean, look at this thing, since 2008. Not so hot. So here are some other ones that are similar. VXZ is midterm. UVXY is double, and it's levered. TVX is double levered. Jen Rhee asked me at the end, XVZ is probably the best of the bunch, but it doesn't trade. And even that's one's down. So I'll show you a short-term VXX trade that I've done. This one didn't work out that well, but I've got a system that works pretty well most of the time. I set up trades with Edge using VXX that have many expirations because it's got great weeklies, ton of volume. So what I do is I buy a VXX at the money option with about 2 weeks to expire. Every time the option increases by 50%, I roll down to a new at the money. if inside a week I roll down and out to 2 weeks. And I'll do this 3 weeks sometimes too, depending on what implied volatility states. If the trader applies the same dollars, you'll sock away cash, so you're kind of hedging yourself. But if you want to go bigger, you can hedge off risk in SPY or SPX. So here's my trade. On Monday, October 23rd, I bought the 35 put for about $1.82. The NOV 10. A couple weeks later, this was actually a rough time to own VXX, and I still made money. Made a nickel. I would have rolled out of this, but it can work. It works really well over time. I've got a long-term play, but I'm not going to talk about that. So let's talk about the inverse ETNs. They are theoretically going to infinity, but they do have a daily tracking issue. All right, there is a general, if you run a constant portfolio that is short VXX, short XIV, with a adjusted, keeping the same constant dollar at risk, you actually will make money on that position. But XIV is the inverse of VXX. ZIV is the inverse of VXZ. ZIV is actually the safer one. And then you have SVXY, which is XIV, but it's optionable. All right. The drag on SVXY is always increasing the value, even if VIX is flat. Generally speaking, yes. Not always, but generally. Here's XIV. Off to the races. I mean, I took this last month, and it's up 20 bucks. I'm sorry, not last month. I took this, like October, and it's up 20 bucks from here. However, I want to point out something. Everybody thinks they're smart owning XIV. Take a look at this drop it can take in a day. XIV and SVXY are the same thing, Christopher. Take a look at the drop it can have in a day. Is this a riskless position? It can drop really fast, really hard. So you have to be careful. You have to do a dollar management system if you're going to trade XIV or SVXY or any of those. So in summary, over time it is not riskless, Brian. There's actually a mechanism that can make XIV have to liquidate, believe it or not. VIX contracts have unique characteristics. Each has their own underlying. IV and VIX are correlated. Alex, explain tomorrow. Bear and bull plays have different structures. VXX and those ETNs are going to zero. Inverses are not. All right, so here's the special. This is for new customers only. New customers only. So, Andrew, who's my partner and my friend and the guy who taught the guy that taught me how to trade, just finished up the VIX Made Easy course. It's a 5-part course where he spends, an hour 15 going each course, going through how VIX works in a way that you'll really understand how everything works. All right, this is not the offer that I wanted. All right. So ignore that. But, so Andrew just finished up this 5-part course. So what you're going to get this 5-part easy VIX class. Or VIX Made Easy class. All right. In addition, you're going to get 1 month of Option Pit Live. New customers only. All right. Now, what is Option Pit Live? Option Pit Live, I come in and talk for generally 3-4 days a week. I'm in for about an hour. When I'm not in, Andrew is in, or Keith, or some of the other guys I work with. All right. You get minimum an hour of chat with me or my experts, and they really are. All right. You get my chat wrap. So every day I go through and I pick out 2 to 3 great ideas that I see. All right. 2 or 3 great ideas that I see. That's terrible. All right. And I put out a 3 to 5 minute video walking through that. In addition, while you're a subscriber of Option Pit Live, about once a month we do a Saturday class. Saturday classes are 4-hour classes where we dig into things like we have a VIX primer, condors, butterflies, calendars. Those are included. All right. You get to attend that class while you're a subscriber for free. All right. In addition, we've got a bunch of great traders in there. One that was giving me garbage through most of the I had one of my traders in here that was giving me garbage through most of the discussion. All right. So every day we've got some awesome content. I'm not. And you get this. The VIX Made Easy class costs $97. 1 month of Option Pit Live is $125. You get the VIX Made Easy class and a month of Option Pit Live for $27. Go to www.optionpit.com/easy. Use code candle70. So you go to optionpit.com/easy, use code candle70, and then you get a month of OP Live plus this 5-part course for $27. Yeah, explanatory, not my best spelling ever, huh? Fixed. The whole slide was wrong. So you go to optionpit.com/easy, use code candle70, $27, and you get a month of OP Live plus the course. I'm sorry, but like, I went to take me and my kid to get a haircut, and I spent $45. Cancel at the end of the month, fine. But give us a shot. You will be happy. After your first month, it's $97 instead of $125. All right. But that $97 gets you the Saturday class, access to me, chat wrap, all sorts of great ideas. I mean, it's kind of a no-brainer, right? $27. Sir, I am in. How do I buy your book? I will tell you. Go to pub. Are you domestic or are you international? VXX option. I went through a VXX. Oh, you're all right. All right. So you go to pub graphics. I actually do have a link for this. I gotta find it. Here, let me leave this up, and then I'm gonna pause and I'll find the link. It's not out of print anymore. They printed more. So the first printing of my book completely sold out. But you can buy it for 28 bucks. All right. Yeah, they did not think that it was going to sell as well as it did. There's the link. All right, it's a good book. Yeah, call it a second printing. So, buy the book and get the and do this. You'll be happy. All right. And if you buy the book and send me a copy of the receipt, I'll send you a little gift. We'll send you the click boxes, Steve. Oh, that's a good book. That's my first book. Yeah, if you like the first one, this one kind of solves all of the missing questions there. I know, Neil. I've got to sit down and do it. I've got a kind of a crazy time around the holidays. I'm going to put these out in the next. I'm going to put the gift out by the 20th. That's the plan. I've got them in my office. I just have to mail it. New websites next week.